partners are law officers. Before initiating the discussion, I would like to mention that these are extraordinary times with many challenges around us. This is a time which probably occurs in once in a century or kind of a thing, and which demands unprecedented measures to be adopted by the individuals to stay safe. Hence, CII wishes all participants and the speakers to stay safe and keep taking care. Though now the economy is being opened up in phases, however, the global spread of COVID-19 and the subsequent lockdown has resulted in unprecedented business and operational challenges. The government of India has taken many proactive measures, which has helped in containing the crisis from assuming catastrophic proportions. However, as the crisis prolongs, it will become increasingly unsustainable for business or industries to manage liquidity and viability. Apart from the demand side impact, the tightening of pandemic's grip has shaken the financial markets. Since 2008, this is the first time that the equity market has hit lower circuit limit. Bond yields have fallen, commodities market has become quite volatile, and the credit flow has also been disrupted. Expanding spreads in the debt market have jolted the confidence of investors. Unprecedented times call for unprecedented and more coordinated measures. See with the current to the policymakers open offers. We had also proposed a dynamic margining system in the F&O segment. We have also recommended to reduce the QI a small glimpse of all the which we have about to share their experience and to discuss key challenges associated with fundraising activities along with recommendations to help improve the prevailing situation. We have with us an eminent panel comprising of Mr. Anjan Agarwal, Executive Director, DCM Origination, India, JP, Mr. Prashant Kolhe, Senior Vice President, Investment Banking, Axis Capital Limited, Mr. Denzel Fernandez, Head Debt Capital Markets, ICICI Bank, Mr. Ankit Kashyap, Partner, Sidley Austin LLP, and Mr. Rohit Raghavan, Partner, L&L Partners. We welcome you all, sir. And to the participants, before just handing over to Jitesh, I would like to just inform the participants that anyone who wants to ask a question, they can, on the right-hand side of the screen, they will see a there. I request Jitesh to kindly take forward the session. Jitesh, over.
Thanks, Deepak. And I'd also like to take this opportunity to thank CII for giving us this platform to speak on this very important topic, along with our distinguished panel. This is a very relevant topic, and the timing couldn't have been better. So thanks to CII and to Sidley Austin for collaborating with us to host this webinar and to invite thoughts from our panel. With that, Ankit, over to you.
Yeah. Thanks, Jitesh, and thanks everyone for joining us on this. I think Deepak did a great job of sort of setting the context. These are, as Deepak said, unprecedented times. Something which hopefully will happen once a century. This is a slightly different situation than an economic crisis, because in economic crisis there are certain policy measures which can sort of have been tried before. People know sort of what may or may not work. In case of a pandemic where there is still no end in sight, yesterday was the deadliest day in the US. So the sort of when we thought things are going back to normal, there's still cases peaking. So we still don't know how this will will go on. So these are sort of unusual times as such, and no one really knows how to deal with a pandemic of this nature that sort of we are encountering. The other thing which is interesting and has been something that we'll touch upon is that governments across the world have sort of thrown a lot of stimulus at this in their own little ways, whether it's America with the Fed, whether in Europe or in India. And that has really papered over a lot of the issues that the companies have at this point. There is a severe disconnect, if I may, between Dalal Street and the real economy. Markets don't necessarily currently reflect the reality of businesses. And that's sort of good and bad. It's good because we're sort of kicking the can down the road, and it's bad because people think things are better than they actually are. So I think that's another sort of thing that we're seeing in the capital raise, where investors are not as enthusiastic about taking exposure on certain types of products, and something that we'll talk about. With that, I think, Jitesh, over to you to sort of kickstart the discussion with the panelists and see what are the regulatory responses so far, and take it away from there.
Thanks, Ankit. Yeah, it's been 3 months since we all went into lockdown and started working from home. And in this period, the regulator has been proactive and has reacted to a lot of situations. And now we are seeing a phase where regulator is preempting the situation and putting forward the groundwork for what could be in the times to come very relevant action. So, for example, earlier today, SEBI has relaxed the preferential allotment guidelines, where they've given an option of 12 weeks versus the earlier 26 weeks. Now, while the jury may be out there whether that's the right step or whether they could have done more, but still, it is nevertheless some action from the regulator. Some of the other things that SEBI has done in the recent past include extending the validity of their observations for IPOs, providing relaxations when it comes to doing fast track rights offerings and fast track of other public offers, reducing the time gap between two QIPs. Also, SEBI has acted on providing some kind of a tax framework when it comes to filing of financial statements, and recently granted 1 additional month for corporates to submit their financial statements for the quarter ended March. So all these steps are steps in the right direction. Rohit, has the RBI also done some similar actions?
Yeah, thanks, Jitesh. Hi, everybody. Picking up from where Jitesh, left off, I mean, of course, the SEBI has done a lot of things for the listed market. The RBI, in its capacity as the central bank, has taken several steps to ease some of the economic pain. Principally, of course, what everyone is already aware of is the moratorium on term loans and postponement of interest payments, which a lot of the banks have extended to most of their customers. That has eased some of the pain, at least, of course, as it's probably postponed the pain. While it has consequences like compounding of their interest obligations, it at least eases some of the pressure because of the cash flow disruption because of the lockdown. The RBI has also helped banks by bringing in a lot of liquidity into the system and nudging banks to lend further into the community through the TLTRO mechanism. Because of the TLTRO mechanism, a lot of good corporates have been able to raise money at very affordable pricing, and also the TLTRO scheme has to some extent helped mutual funds meet their redemption obligations because of TLTRO money is getting invested in the secondary market in terms of debt. Of course, most of these are temporary measures, and some of them have also been challenged in the courts. And there are certain other issues such as redemption of pledges by banks, which have been challenged because of the sharp fall in valuations because of the pandemic. And the Bombay High Court has, in one case, set aside such an enforcement, saying that the same should not have been done by the by the lender. Now, this has implications for the financial markets as well. We have to see how some of these band-aid measures actually whether they help or not, but the jury's out on a lot of these things, and of course we don't know how things are going to pan out in the next few months.
Yeah, Rohit, I think the need of the hour is basically several corporates are looking at the market and want to raise capital where in a very timely fashion and with as less regulatory intervention as possible, and looking to time themselves to market. And the current market scenario is very choppy, and people are not sure when they will be able to access the markets and in what manner. So that's why I think this panel makes a lot of sense to talk about the various fundraising options that could be available to corporates to deleverage their liabilities, because in these times it is important to cash is king, and to accumulate cash and also try and meet any cash shortfalls that corporates have. So, Prashant, coming to you, what sort of deal activity in the equity markets have you seen in the last 3-4 months, and how do you compare that to the periods before that?
Thanks, Jitesh, and thanks everyone here. I think we are going through that unprecedented time of COVID and the subsequent lockdown, and the immediate impact of this lockdown was visible even in the early days, as we saw considerable fall in the fund mobilization from March 20 to April 20. So if you look at the figures across various capital market instruments, whether it will be a public issue or private placement or preferential allotments or capital, just a very quick comparison if you look at it. So funds mobilized from the public issue fell to just 14 crores in April vis-a-vis 11,000 crores in March. And private placement fund mobilization as well as come down drastically, not to the extent of public issues, but it still came down to 55,000 crore plus compared to 95,000 crore. And there was not a single QIP or IPP during this March or April months, which was the starting period from the lockdown. So overall, if you look at it, there was not a single product, single route, whether public or private, where there was not a considerable fall in the quantum of the funds mobilized. So that was a fact. So if you look at it, most of the equity deals we are seeing in the market are from the private placement side, and there have been almost 2 QIPs and 14 preferentials aggregating to some 10,000 crore plus. We have just witnessed the successful closing of Kotak Bank and JM Financial QIP offerings. So with such offerings, market could witness more QIP offerings in the latter half of the 2020. Interestingly, if you see by mid-June, almost 2,000 crores of buyback has also happened in the market at this point of time when we are talking of conserving the cash. The important and more interesting trend which I would like to highlight is about the rights issuances. So in March, there were hardly 3 rights issuances. April, there was none. But now, presently, we are seeing a lot of interest is being generated towards fundraising through the rights issuances, particularly from the sectors where they are affected from the market volatility and depressed share prices. And a lot of activity is seen, especially in the financial sector.
Thanks for that, Prashant. Perhaps, let me just throw the ball over to Denzel and Anjan. What trends are y'all seeing on the debt side?
Yeah, good evening to everyone, and good evening, Rohit. Well, I think bearing the initial few weeks in April, where we saw high volatility in the corporate bond activity, the activity post that has been very robust. We have seen issuances to the tune of 1.9 lakh crores year till date, spread across 300 issuances. If we compare this with the first quarter of last fiscal, that number is around 1,25,000 crores. Another important, out of the 65,000 crores has been raised by private sector non-financial, which augurs well when you compare it again with a similar number last year, which was around 30 to 35,000 crores. Having said that, we'll have to look at both the numbers with slight caution, because in this year we had the benefit of 1 lakh crores through TLTRO, which was not there last year. There have been a few positives which I would like to enumerate. For one, we have seen a lot of new issuers who have accessed the capital markets or the bond route. We have also seen some amount of infrequent issuers who have also come in and accessed the bond. I think one reason is everyone would like to sit on liquidity given the current uncertain environment. Similarly, I think a lot of pedigree issuers have front loaded their borrowing program to take advantage of the ample liquidity as well as the lower rates that we have seen. Needless to say, a lot of bank money chased these high pedigree issuers, resulting in some of these issuers, the other guys being left out. So that has been one. Normally, when you see a situation where there is ample liquidity and low overnight rates, you would expect that corporate bond spreads should have come off significantly. However, in the months of April and May, we really didn't see that. But in the last 3 weeks of June, we have started to see some amount of spread contraction for AAA rated issuers. We hope that this will augur well the other rating issuers as well. However, on the public issue side, I think things are far from what we have. We haven't seen a single issuance this quarter against 15,000 crores of issuances last year. If you notice, public issuances was one of the wanted to generate to tap retail money through the NCD route. However, post 2018, we have seen investors shy away from the public issue market, which have also resulted in many of the investors not many of the issuers actually not preferring this route. But if you look at prior to September 2018, we used to have around 40 to 50,000 crores of NCD issuances through the public issuance route. Anjan?
Yeah, thanks, Daniel, and good afternoon, everybody. And thank you for having me at this forum. If you look at the dollar bond markets, effectively in the month of January and February this year, we saw almost more than $7 billion of issuances by Indian corporates across various sectors. However, when the COVID started, the spreads increased. And one of the critical reasons for the spreads increase was the fact that the flow of capital was moving out of the emerging markets. Over the last 3 months, we have only seen 2 issuances coming into the dollar bond markets, one by REC and one by UPL, both raising about $500 million each. Now, what has happened is that we have seen that the flow of capital in the emerging market has started to come back and the spreads have started to come down, which has allowed the yields to come down and allowed the investment grade companies to raise more capital. However, these yields are still not at the same levels what they were in the month of January and February. The other point to note is that the yields is quite wide even for the high yield names. In case of high yield, investors are continuously questioning the stability of the business, the growth, the liquidity. Some of the factors which were quite given pre-COVID scenarios are becoming the top questions or diligence matters for the investors. We do expect that the markets, the liquidity in the market will continue, and we do expect that investors will continue to deploy capital, but they are expected to be quite selective. In terms of the corporate issuers, we are seeing increased activity, and we are seeing corporate issuers both in the investment grade as well as high yield getting ready because they need to tap the market at a very small and opportune window as and when available. Nitesh, back to you.
Sanjan. So that rounds off, the broad overview of where the trends are and in the market and, what's happening in the markets. Now, it's time to go slightly deeper into, what kind of products. are we seeing being more prevalent? And one thing that comes to mind is rights issues. Everybody knows about the Reliance rights offering that happened recently. And Prashant, maybe I should pick your brains on, what is the reason behind this popularity of rights issues, according to you, amidst this whole crisis? If you can shed some light on what are the factors that are playing a role.
Sure, Jitesh. So if you look at it, Jitesh, rights offering has traditionally been the preferred routes for raising the funds because of primarily it's more democratic and anti-dilutive. So in the rights issue, we are raising the funds from the existing shareholders to the extent of their holding. And in a way, it gives an opportunity for the issuers to reaffirm the shareholders' faith into this business. And at the same time, it rewards the shareholders by offering discount for their continued support. So it's kind of a win-win scenario for both of them, as long as promoters have that kind of a liquidity to participate in the issue. So companies worst affected by the crisis, such as financial services, retail, hospitality, entertainment, you can witness a lot of activity for the fundraising from the rights issuance perspective. And that's also that fund mobilization important from the sustainability of their business. And if you look at it, rights issue as an instrument also offers you a lot of flexibility as a tailor-made instrument for the staggered financing, and something like you can issue partly paid up shares, NCDs, convertible CCDs. So thereby ensuring higher investor participation to address their liquidity concern at a point of time. So if you look at it in 2007 and 8 economic crisis, post that also there was a lot of fund mobilization through the rights issuances. And I'm very sure at this time during this crisis also rights issue will emerge as one of the viable product for raising the funds for the corporates. Because it's kind of a faster mechanism. You only go ahead with the board approval. You don't require any shareholders approval for going ahead with the rights issuances. And also says upon the negative influence of the proxy advisors that would have. And SEBI is also proactive, so credit also goes to SEBI because the rights issue reforms were done in January 2020, and current relaxations on the rights issue also help a lot in creating an interest in this field. So we have just, as you rightly said, recently seen the mega issue of rights, Reliance Industries rights issue, and several rights issues, just to name, such as M&M Financial Services, Future Retail, Aditya Birla, PVR, Shriram Transport Finance, to name a few. Market can witness a lot of activity on this rights issue front. Reliance as such is one of the biggest rights issue ever done by a corporate, and understand that's also one of the biggest by a non-financial institution in the world in the last decade. So if you look at the statistics, the highest ever fund mobilization through the rights issuance in any financial year was done actually in 2019-20. At that point of time, almost 13 corporates raised close to 56,000 crores of mobilization through the rights issuances. And prior to that, that record was for 2007 and 8, where 32,000 crores were raised. But I'm sure this time, because of this situation and the interest that is being created for this particular instrument, this current FI is certainly going to surpass that record of 1920.
Thanks, Prashant, for very insightful comments on the rights issue process, and helps us understand the product so much better. Ankit, over the last few years, you've been focusing on the India market from Singapore, and you remain quite active on various other fundraising options such as IPOs, QIPs, besides rights offering. What sort of deal activity are you seeing on the other products, and compared to previous year, and if you can also draw comparisons with what you're seeing in other markets, and what sort of activity is happening in other markets?
Yeah, sure, Jitesh. I think, look, other than rights, there is very limited activity on the equity side. QIPs and IPOs have been hurt for a variety of reasons. QIP because and both IPOs, I guess, because investors don't know, as Anjan pointed out, what the exact impact of this is, and there are sort of questions, very basic questions around even cash flows in the next quarter and stuff like that. And there's not enough clarity for someone to take a punt on an IPO in this market. It also doesn't help that the existing listed stocks have been trading at decent valuations. So if somebody had to really take exposure to a real estate company or a hospitality company today, they'd rather go to a listed player than try and invest into an IPO context and sort of take more risk there. A lot of money has been raised on the equity side, but I think we'll have to sort of, again, as Denzel said, take it with a pinch of salt and sort of delve deeper to see who's raising this money. Most of this money has been raised by way of blocks, which is investors trying to take the chips off the table and taking cash out of the market. So while the numbers of how much money has been raised on the equity side is huge, a part of it is just investors taking money out. We had the largest block trade ever done in India by GSK recently. So those kind of deals have been very prominent. A lot of blocks have been happening. There was a Blackstone REIT exit yesterday or day before. So there is a lot of big ticket activity happening on the equity side, but most of it is investors taking the chips off the table. So you've got to be very careful of how you look at those numbers. So very few growth capital coming in. The other thing that we're sort of seeing is IPOs are happening in the US, but very, very specific sectors. There have been a bunch of biotech IPOs which have happened. Biotech has been the buzzword in the US throughout this year and more so after the COVID situation started. We've seen certain niche industries go and do IPOs. Wonder Music listed about a month back. Room listed, which is a selling of used cars platform. So there have been IPOs, but there hasn't been a widespread activity in the US either. Again, very, very quiet in Southeast Asia as well, another region that we'll cover out of Singapore. There has been a lot of money raised in China vis-a-vis Hong Kong listings. The big ticket sort of IPOs happening in Hong Kong. Hong Kong had its own issues with respect to the political unrest recently, but with the US-China trade tension, a lot of money has been moving. At least the big Chinese businesses have been doing dual listing in Hong Kong. So there's been mega IPOs happening in Hong Kong, which is interesting. On the debt side, in China, again, a lot of investment grade deals are happening. IG deals have been happening. There is liquidity there. Since mid-May, we've seen a fair amount of activity there. But when it comes to high yield, the activity is not that much. The weaker ones, weaker companies will need to offer higher coupon, hoping to get a deal price, and there has been sort of disconnect on what's a good price with the amount of volatility around. So not a lot of high yield action, but certainly investment grade. Similarly, and I think it's an interesting point, a lot of big deals are happening. You're not seeing a lot of deals happening, but you're seeing a lot of big deals happening. And the way we sort of put it down to is sort of big businesses trying to create a war chest. So even Indonesia has seen 3 or 4 couple of $1 billion deals happen in the last month. But that's the only deals which have happened out of Indonesia. So which is interesting. You're seeing big deals. So there is liquidity in the market. There are people who can sort of mop up cash, but people who are able to do that are very few and far in between, and the market isn't same for everybody. So you're not seeing a lot of deals go out, but you're certainly seeing big deals go out. Just on that basis, I guess if I could ask, the other panelists, Prashant, maybe starting with you, what are the other challenges you think people are facing raising money in this scenario where there's lockdown, everyone's working from home? How is that impacting capital raise? What kind of sort of impact has it had on your sort of deal making?
Yeah. So Ankit, the most obvious impact of this downturn on the capital market is the reduced investor interest, and hence the limited options for the fundraising. So typically, if you look at it, investors has earlier faced the economic crisis, but presently what we are going through is not only economic, but it's kind of a global healthcare crisis, and we don't know how long it's going to continue. What is the end of it? Will there be a vaccine or a solution available for this? And how long this impact is going to be there on the business operations of the companies? Yeah. From that perspective, there is virtually reduced or no investor interest appetite available. At the same time, because of this lockdown, there are restrictions for the travel, and we have witnessed several corporates have actually cancelled their roadshows or marketing visits for the offerings. Several IPOs have also been deferred because of this market volatile conditions. Although retail has taken advantage at this point of time of the reduced market price to invest in the large cap. Two important trend from our Indian market perspective, if you look at it, typically majority of the all Indian companies are promoter driven, and when you raise any kind of a fund, there will be an impact on the dilution. So dilution coupled with the volatile market price and at a depressed price raise the question, and that is the important criteria for them to choose whether the price at which the dilution should be done or not done. So significantly, this COVID has impacted on the market prices of most of the companies, and most of the cases, the issue price is linked with your current market price. So obviously, some reluctance or less incentive in diluting at lower prices. But as you see, there may be some cases where the market price is not at all impacted due to COVID. So there may be reluctance from the investor side, whether to invest at this point of time because those valuations are not giving the current picture, current status of the business situation at there.
Yeah. Denzel, from your perspective, and then I guess how you can follow from on the debt side, what are you guys seeing?
Yeah, so just to sound out about the virus, I think this is probably the first time where we've seen for distress moving from real economy to financial markets. Whenever we have seen the crisis earlier, it has always been financial distress moving to real economy. You call it in 2008, that happened. You call it in 2013, the rupee dollar crisis. It has always been financial distress moving to the real economy. This is probably the only time where we are seeing the reverse holding true. So I think, of course, there are a lot of challenges. And the key challenge for me, I think, given the prevailing uncertainty and where corporates really don't have a sense of how the top line or the bottom line will really shape up. From a debt perspective, I think rating migrations to me are very significant risk, because really from an investor perspective, you really don't know how to price credit in an environment where you don't know how the rating will change in the next quarter or the quarter after that. So that is definitely one key challenge. Liquidity is another. I think, during all pandemic situations, investors just prefer to sit on cash rather than invest. This is actually creating a problem in terms of slowing down the capital formation. That's the other part. We have seen the fiscal deficit numbers both for center and state increase. So obviously that will result in greater market borrowings both by central governments and state governments. That could potentially have an effect of crowding out the private sector if the liquidity situation deteriorates rapidly. Currently, we don't foresee that situation because there is ample liquidity in the system. But in the next 6 months or post that, we'll have to reevaluate that. Another thing is the risk aversion from end investors towards lower rated private sector credit, especially after the capitulation of the Franklin Templeton credit risk fund. Just to give you a perspective in terms of numbers, the AUM of credit funds actually stood at around 150 to 175,000 crores prior to the one crisis, and today we are at around 50,000 crores. So effectively telling you the psyche of the ultimate investors. Anjan, over to you.
Thanks, Denzel, and very valid points being raised. I think from my side, I'll just add a couple of other points. Is that what is the real impact of the COVID-19 on the businesses? Even for corporates themselves, they themselves are difficult to understand that what should be the sustainable level of operations once things get back to normal. How much is the pent-up demand and how much is the actual demand? There are industries which are getting directly impacted, like the hospitality sector, whereas there are industries which are getting indirectly impacted, in the nature of supply chain and some other availability of migrant laborers and workers for their business. So therefore, in the medium term, each investor and corporate will try to understand is what is the real impact of the COVID-19 on the company that they're evaluating or the issuer when they look at. We believe, and which we have also heard from a lot of the corporate seniors, is that the real impact of this entire COVID will start coming post the September 2020 results, when we'll see the impact of COVID for the 6 months, where 3 months is broader, we were taking lockdown period, and another 3 months is the recovery period. The other point I would also like to highlight, and which Denzel touched upon a little bit, was on the rating agencies. If you look at the international rating agencies, we have seen significant actions taken by them with respect to various corporates in India in terms of rating action. Now, the biggest challenge they also feel is that how do they model the business of a company for the next 3 to 5 years? Because is the impact of COVID a one-time impact, which they can take for the year of 2021? Or is the COVID impact a more permanent and a new way of looking at the business altogether? Therefore, these are a couple of other challenges that we see in the market. Jitesh, over to you.
I just want to add that it's not just on the investor side and even on the seeing deal activity, but even us lawyers are facing difficulties with document execution and availability of stamp papers. Sometimes they are available, and sometimes they are not. Sometimes we are able to get stamp paper online, and sometimes there is the website gets clogged and you can't download the stamp papers. So there are similar kind of issues we are also facing during this pandemic. And I believe, Ankit, you had some stories to share about roadshows now moving to online roadshows.
Yeah, so I think, yeah, again, because of this constraints on travel, a lot of roadshows have moved online, and people, at least some of the clients who are sort of repeat issuers, are questioning the need for an online, a physical roadshow at all, because they've been sort of on these grueling travel schedules where they do 7, 8 meetings in a city and then hop cities every evening, and people are now questioning whether that was ever required. So I think it's not having people question the way transactions were being done with diligence. Should everything have been online, data rooms, etc., all the way, or did we need physical diligence at all? Do we need physical meetings at all, or should have we been on Zoom or Teams? I think that you will see a lot of this impact play out over the years as to how transactions are sort of contemplated and completed. On that note, Jitesh, you've been working on transactions before the pandemic hit. How are you seeing the change happen on transactions that you've already been working on, or has that lockdown impacted new transactions taking off? How are you sort of on that front, and what are you seeing?
Yeah, the lockdown has certainly affected ongoing deals. When it was enforced, it had an immediate stilling or freezing effect on IPOs, as you had already mentioned. So IPO activities just come to a standstill. In the last 3-4 months, there have been very few DRHP filings with SEBI. Only one filing was made very recently with SEBI, which was for Happiest Minds, and that's in a sector which is relatively unaffected by the pandemic. It's in the software consultancy and IT. Now, any other deal activity so far had also had a witnessed a chilling effect, because the pricing mechanism was intrinsically linked to the historical prices, and until very recently, when now the SEBI started bringing in some of the changes, the whole scenario was not tilted in favor of doing a deal, because the actual price of the stock and the historical price, there was a lot of variance, and so a deal could not be struck. And so now we are seeing deal activity revive in some sectors. I think some of the sectors that are seeing deal activity and where we've started receiving some interest: infrastructure, financial services, manufacturing, besides rights offerings for hospitality, financial services, retail, entertainment, transportation, and hospitality. Those are the sectors which are also some of the worst affected by the pandemic, and so they are in more need for capital than some of the other businesses, which may or may not have been insulated. It's yet to be seen. Uh, Another pipeline of deal activity where we might see some action, either regulatory or uh, if there is lack of regulatory action, then you might see people going ahead and doing those deals, is the small finance banks. Now, small finance banks have a deadline imposed by the RBI. They need to comply with it. Either that will happen, or they will go to the RBI and RBI will understand their concerns, especially after the COVID. Their PNL and their operational performance may not be right for an IPO, and it probably may not make sense for them to go ahead and do an IPO. So that said, this is on the equity side and some of the deal activity on the equity side. Now, Rohit, Denzel, what are you seeing on the debt raising side, and what kind of trends are emerging in the last 3-4 months?
So Jidesh, I think on the debt side, the principal thing is that there is obviously not much appetite for expansion capital right now. Nobody is really taking those big decisions. And probably whatever decisions were taken are also being reconsidered right now. Most of the demand in terms of debt funding has been in the working capital side of things, improving liquidity and access to cash, because liabilities aren't really going down all that much. There are some fixed costs which still need to be serviced, and salaries and things like that. So working capital demand is through the roof. A lot of work we are seeing in the market is in working capital, increasing limits, or accessing maybe trying to use leverage or shareholding in listed entities sometimes to raise funds as short-term funding. But then, of course, you may have heard of the Bombay High Court judgment in future retail. So even that's now not exactly a favorite with the lenders, because they don't know whether there's a market for listed shares and where they will stand 3 months down the line in terms of valuation of those shares. So that's becoming a problem for borrowers. Denzel, I mean, what are y'all seeing in the listed NCDs, unlisted NCD space, etc.? Are you seeing some activity there, or perhaps other kind of papers?
Thanks, Rohit. Well, I think we have seen a significant amount of activity in when it comes to shorter tenor commercial papers, um, because they have been actually supported by ample liquidity and lower overnight rates. So, just to put it in terms of numbers, the outstanding CPs have increased from 3.44 lakh crores as of March 31st, 2020 to around 4.25 lakh crores as on May 30th, 2020. So that's seen a significant jump, and the rates are also very, very compelling for corporates to access the CP route. Yeah, for very good corporates like the L&Ts and the Reliances of the world, they're mirroring the 6-month CP rate mirrors the overnight rate. In some cases, it's even lower than the overnight rate. So it's a very, very compelling story for them to raise money through CPs. Having said that, however, for issuers who are slightly lower rated and who are looking for longer tenor bonds, maybe 5-year to 7-year or 10-year, we haven't seen that sort of optimism, and this is mainly because of lack of investor demand. Corporates, on the other side, corporates who have had unutilized credit lines with banks and who wanted to utilize them have also faced some challenges when it has come to terms in terms of the end use, where banks were not able to fund them because of the end use restrictions. So those are the scenarios that have happened in the market, Rohit.
No, and also, I mean, I think the RBI moratorium has also been selectively applied in the market. Right? I mean, banks are offering it to their borrowers who have taken loans, but the same RBI moratorium is not being offered to NCDs, and definitely not being offered by overseas creditors. So that's creating a sort of imbalance in the market, because we don't know, borrowers are not able to plan their funds, and naturally the cash flow stress that they're facing is not being equally supported by various categories of lenders. There's also obviously the stress of refinance, because the financing cycle needs to continue, and periodically refinancings do happen. Again, because of the change of circumstances, refinancing is also facing a lot of stress. A lot of times refinancing used to happen with overseas bonds, as Anjan would know, and that is itself a big problem, because those markets have completely transformed over the last few months. We were also seeing a lot of funding happening from overseas parents, which used to come in through FPI and a shareholder ECB. That is also something that is something we are going to see, because if the banks are not able to provide liquidity, that's something that will happen a lot. There's also been some relaxations by SEBI, especially for bonds in the NCD space. I mean, the relaxations from a credit rating perspective have been given by SEBI, and delay in payment of interest, etc., is also something. And during COVID, is something that SEBI has said should not be taken into consideration for credit ratings. So that's a small ray of sunshine for NCD issuers. Hopefully, lack of the moratorium is being compensated for in some way over here. But I mean, there is obviously a lot of clamor in the market for that moratorium to be extended to NCD holders, NCD issuers. I'm sorry. There is, at least there should be an option where NCD issuers can seek a moratorium, given the fact that there is no regulatory blessing for the same. That's not really happening right now. Broadly, I think majorly things that are happening in the net space and issues that borrowers are broadly facing that we have seen. Then, in terms of scenario, raising debt capital, what do you think are the steps that have been taken so far? And in your where do you think we stand on this?
So thanks, Rohit. I think I agree with you on most of the factors that you've listed above. Just a slight disconnect when it comes to moratorium on NCD payment obligations. I have a slightly different view there, and it stems from the fact that the bond market typically needs to be accessed by issuers who are typically better rated. Else, there is an option of the loan market. Secondly, I think unlike loans where coupons are paid monthly, in bonds the coupons are paid annually. So, and thirdly, a lot of the retirement funds or others, they have a liability to service based on the coupons that they receive. So to that extent, I'm not sure whether the NCD moratorium that you're suggesting could lead to a good credit culture in terms of bonds. However, with regard to the steps taken by the Reserve Bank of India, I think the Reserve Bank of India has been really, really proactive to ensure that they are at least, if not at the curve, ahead of the curve, given the sort of unprecedented volatility and stress that we've seen in financial markets in the month of March and April. So the Reserve Bank of India had launched a TLTRO, that is targeted lending repo operations, to the tune of 1 lakh crores, wherein banks were incentivized with this money to go and on lend to issuers having an investment grade to the tune of around 1 lakh crores. A lot of issuers, especially the large corporates, have benefited from this, like name it, the Reliances, the M&Ms, the L&Ts, and the Tatas have tipped into the TLTRO route to raise debt capital. So that has definitely been a positive. That has also impacted yields in a very, very positive way by bringing down yields. Based on this success in TLTRO1, the Reserve Bank of India also thought that they will opt for TLTRO2 to the extent of 50,000 crores. And that was specially targeted to the SME, MSME, and NBFC sectors. However, things were not very successful there, and the offtake there was only to the extent of 12,500 crores, mainly because I think banks were already heavily invested with this sector, and they didn't want to further lend to them unless they had some form of backing from the government or the Reserve Bank of India. So that is there. However, the RBI did come up with an SLFMF scheme to the extent of 20,000 crores. This was immediately after the Franklin Templeton episode, where they said that banks can purchase close to 20,000 crores from the secondary market from mutual funds. This was a very timely move because had they not done it over the weekend, we could have seen, the corporate bond yields and credit spreads just blow out. And that timely intervention helped to, calm the investors in mutual funds, calm the sentiment in markets, and has really ensured that all the good work they did in TLTRO1 was not undone. Yeah.
Right. Thanks. Thanks, Denzel. Anjan, on the sort of international foreign currency denominated debt side, what are you seeing in terms of key challenges? I know you're getting a lot of queries at this point. What are you telling your clients?
Sure. I think in terms of the challenges, I would talk about 5 points, and many of those points are interlinked to each other. So the first point itself is the market liquidity. I touched upon this point earlier also, where the flow in the emerging markets is a critical determinant of how investors are taking on additional risk. Now, markets always come back. They will come back because investors need to deploy capital, and therefore we will see them coming back. It's a question of time, and it's a question of price. Their expectation on price will be higher as compared to what they were expecting in the month of Jan and Feb, or even what they were expecting last year. But they will definitely come back. Now, what it does is bring to the second challenge that the existing corporates needs to pass away this particular time, ensure that they have sufficient liquidity before the markets come back and they're able to raise the capital. Now, Denzel earlier had mentioned that so a lot of the Indian corporates are facing challenges on raising capital or drawing on the undrawn lines from the banks, because suddenly this COVID impact has had a very significant impact on the liquidity of the corporates as well as the liquidity of the bank and the financial markets. So the corporate liquidity is also creating another challenge for them to go ahead and raise capital. That brings us to the third point, is that if the maximum requirement of the corporates today is on the working capital side, is to ensure that they pass over this particular short-term mismatch in their cash flow, how to do that? Now, ECB has always been a constraint in terms of the regulations, because as per the existing regulations, corporates can only raise a 10-year capital for working capital or general capital purpose, which kind of defeats the entire requirement of what corporates are looking for. And therefore, that acts as an additional challenge. Two other challenges that I would like to talk about is one on the rating side. We have seen that Moody's downgraded the Indian ratings from to Baa3 from Baa2, and they have also made the outlook to be negative. Further, we have also seen Fitch changing the stable outlook of the Indian sovereign to negative. This has had a impact on a lot of the state and the corporate issuers, because their own ratings has got impacted. And we have seen a significant number of public sector undertakings outlook being changed to negative, and even some of the companies downgraded from investment grade to high yield category. So therefore, the ratings impact is a real impact, and that also adds to the challenge. The last I would say is the real always mismatch of a dollar or a foreign currency borrowing with the INR business that they have, FX. This has been a challenge, and a lot of the corporates in the past has not gone to the dollar bonds market simply because of unable to manage the risk in a most efficient manner. And this risk has the current COVID has only added to the volatility in the market and added to that risk, thereby increasing the challenge for corporates to raise a foreign currency borrowing.
Thanks, Anjan. So, uh, some of the regulatory action that has happened can be put in, two buckets broadly. One is the, reactionary bucket of changes where the regulator has reacted to a particular situation or a particular demand. The second is more a preemptory kind of change that the regulator has brought in, also on demand from the industry. But this category of action is appearing to be more timely and also preemptory. Now, one of these actions was when SEBI brought out a consultation paper sometime in latter half of April, where they said that for stressed companies, they will make it easier to raise money through preferential allotments and allow white knights to step in and help a stressed company raise capital where they find these stressed companies may find it difficult to even find some kind of working capital support or even find some other kind of support in the form of bank lending. And so, that action was very timely. And now, very recently, SEBI implemented what it said in its consultation paper and brought out relaxed pricing norms as well as exemptions under the takeover code for those norms. Prashant, you want to talk a little bit about these changes and what sort of impact do you think they will have on the behavior of institutional investors and how much will these changes help stressed companies?
Sure, Jitesh. As you rightly said, SEBI has proactively brought out these amendments, and I'm sure credit must be given to SEBI because that's a dire need of time at this point of time to have such kind of amendments that will help the stressless assets to have a viable fundraising option for them. So if you look at it, SEBI has provided these relaxations and amendments for investment into the stressed listed companies by way of a preferential allotment route by a person who is not linked with the promoter or promoter group. And these amendments or relaxation or exemption basically are on twofold. One is relaxation from the onerous pricing restrictions, and second one is exemption from the takeover code, as rightly just pointed out. And intention of this to make it a viable fundraising option, and eligibility for being a stress listed asset, a stress listed company to take those benefits are basically they need to satisfy 2 out of the 3 conditions which were already mentioned in these papers. Typically those are talking about disclosure of default of the issued instruments, existence of intercreditor agreement under the RBI stress assets resolution framework, and downgrading of the company's rating to D grade. So any out of these 2 conditions, if they satisfy, then that can be eligible as a stress listed company. So if you look at those relaxation from a pricing perspective, the floor price formula for the preferential allotment into these particular companies involves a 2-week look back period vis-a-vis the 2-week versus 26 weeks. So that's a very welcome move and making it more interesting from the investor perspective also. And takeover regulation has exempted even if any investor has invested through this preferential route into these companies and acquired the control, they have been exempted from making the open offer into this. So certainly due credit should be given to SEBI, but still some question is there as why promoters are not getting the benefit of this relaxed pricing norms. Because if you look at it, if you look at it, the approval of the issuer, approval for such issue is always subject to the approval from majority of the minority, so they can decide it. And also the condition for the lock-in requirements is for the period of 3 years, which seems to be slightly disproportionate if you compare it with the other capital market instruments in the lock-in available for the investors. So we can look at it. Coming back to the second part of your question about the institutional investors' reaction to this. So I think they can find it as an alternative investment opportunity to invest into these distressed assets. But the key question is whether they do it, whether they need to revisit their investment policies and investment restrictions to determine, and if they can't, what kind of a consents or approvals they need to take from their investment so that it can be possible.
Yep. It looks as if there might be some more word on this one. This may not be the last word on this move, and there might be some more clamor for relaxation on the promoter holding, or promoter participation, and also on the lock-in front. So, we should keep an eye on this space.
Yeah, we can expect a lot of slew of activities around this point. Yes, the recent announcement has been done, but we can expect slew of activities.
Prashant, just because you have you on the equity side, there has been some discussion around again allowing overseas direct listing for Indian companies. This is a topic which sort of becomes hot and cold every few years, and we haven't really seen much activity. There was an announcement made, and then nothing really happened after that. There were no sort of amendments proposed to any of the regulations. What do you think of are the chances of it happening? And Anjan, I guess for you as well, are you seeing any activity from clients on that side? Are people sort of asking you questions as to where we are and whether this is realistic? And I guess, Prashant, starting with you.
Yeah, so Ankit, as you rightly said, this has been on the anvil for a long period, and government has made announcement a couple of earlier occasions also regarding the direct listing of Indian corporates overseas. And I believe there is a SEBI has come up with an expert report also on the same.
Yeah.
So, however, although despite that, much remains to be seen as how such framework should be implemented. If you look at it, a lot of enabling provisions has been made in the Companies Bill 2020, but a lot of clarities and details are yet to be crystallized on that front. So something like classes of public companies which will go for such kind of overlease, classes of securities or jurisdiction we are talking about. So present scenario, if the Indian corporates want to tap from the foreign markets, that can be only done through the issuance of depository receipts. And only listed companies can, or through simultaneous listing of through India and overseas, they can issue the depository receipt. Yeah, India.
I think, Ankit, to your question, effectively, we are seeing a lot of interest from corporates for overseas listing, simply because the pool of investors and the depth of investors that you can access, be it in Hong Kong, Singapore, New York, or London, is quite vast. And they understand various business models. So for global business model companies like IT, fintech, e-commerce, pharma, listing in the overseas market actually makes a lot of sense. And we continue to see those interests there. However, as Prashant also mentioned, and I think some of the challenges that continue to remain is obviously the preference of a dual listing vis-a-vis a direct listing overseas. We also understand that it also poses some challenge on fungibility, because this requires a full capital account convertibility, which is still missing. There are practical operational challenges in terms of accounting and reporting standards, which is different from what we see in India vis-a-vis what investors expect overseas. And I think there's also one more challenge with respect to taxation, because how would you ultimately tax capital gains between a transfer from a non-resident to a non-resident? So in a nutshell, I think there are challenges which still remain. However, we as a group continue to remain hopeful that the regulators and the various intermediaries will try and solve all these challenges over the course of time. And therefore, this direct listing or overseas listing will see the day of the light soon.
Right.
Thanks for that, Anjan. But Anjan and Denzel, I have another question. In terms of overseas debt as well, there are certain regulation fixes that are there in terms of ECBs. What are the kind of relaxations that you and your clients are looking out for to make those markets more attractive and accessible?
Sure, Arav. So if I may start, means if you look for any particular foreign investors and when they want to invest in, say, Indian credit, they effectively have two routes. Either they can come through the FPI market and invest in the INR debt securities itself, or they can come to the ECB market and therefore they can invest in a foreign currency or even in an INR currency through the ECB route as well. However, both this route has its own challenges in terms of what restrictions apply. So, for example, within the FPI, if they are coming through the VRR route, which in a market like this, investors would want to have the flexibility of taking out capital earlier if it needs to. There was before the VRR, the FPI investments also required that not more than 50% of the investment could be invested into a single corporate. Today, a lot of the investors would not want to invest at one go into multiple entities. They would want to rather try out, look at one entity, and therefore come start expanding their portfolio. If you look at the ECB leg, I think the end use restrictions continues to remain the biggest challenge, because ultimately today corporates are looking for working capital and general corporate purpose capital, whereas for that you need to have a 10-year investment horizon. So those continue to add to the challenges there. Denzel, anything to add from your side?
Thanks, Anjan. I think you've nailed it bang on. The 50% restriction on FPI investments, I think, primarily relates to parent subsidiary transactions or deals involving related parties. There could be a case to view this subject to, adequate strictures in place to address regulatory concerns. There's another thing as well with regards to FPI investments onshore. Current stipulation says that only 20% of the corporate bond portfolio can be invested in maturity of less than 1 year at any point in time. Now, this severely, restricts how the portfolio composition of FPIs can be, and would also encourage them or force them, I may say, to compulsorily, churn their investments, even though they may not willingly want to do it. So I think these are some of the issues which are hampering some of the FPIs from being far more active in the domestic bond space. Yes.
Now, another way of raising funds could be securitization of a pool of assets. Are you seeing some activity there or some kind of regulatory developments there?
Yeah, so the securitization space is something that's not been too active except for ARC. I think the RBI has come out with certain norms to make this a bigger field, improve access. A draft framework is out actually overall on transfer of standard as well. It covers everything from pretty much in the loan market. What actually has been positive there is that single asset securitization is something that's been proposed. I think that's a good move to help players in the real estate sector like housing finance companies especially. And also, I think there are some liberalizations that are proposed in minimum hold period and all of that. So it's definitely a positive move in the right direction.
I think just another point to add out here is also that there's a proposal to allow Indian bankers to acquire exposure in equity, otherwise than in the capacity of the underwriter, which means that the Indian banks can effectively take over the foreign currency debt of Indian issuers. And this will be a very important factor when they are looking at restructuring or refinancing, because it will help consolidating the loan portfolio within of a group of lenders before going for such refinancing and or restructuring.
Thanks, Anjan. I guess switching back tracks to the equity market, Jitesh, Prashant, you guys are sort of closer to this. I know SEBI's done a lot, and we've sort of spoken about it so far as to what sort of changes they have proposed and in the recent past to try and deal with this pandemic. I know all of us have wish lists at all points of time, irrespective of what the regulator has done so far. So maybe starting with you, Prashant, what is your wish list today? What would you like to see change in the sort of coming weeks and months to try and support the equity markets?
Yes, I totally agree that SEBI has very proactively come up with lot of amendments on the most of these regulations. But as you rightly said, there is never ending wish list. So product wise, if I can say, let's say for the preferential issuances, if you are talking about, then preferential issuances to qualified institutional buyers, where the pricing is linked with the look back period of 2 weeks. There, the existing the limitations on the number of investors is 5, so that can be increased to 10 or 15 to make it more viable and interesting. SEBI has recently, I think today or day before today or yesterday, only come up with some pricing change in the preferential issues with the look back period of 12 weeks vis-a-vis 26 weeks now, that I understand. But the idea is basically let it be in line with the pricing relaxation available to the stress companies, that is look back period of 2 weeks. That can be on my wish list. And
And
particularly,
SEBI has done it before in 2008 as well, right?
correct,
So,
correct,
yeah.
correct. And if I say the wish list that is top on my list is basically increasing the tenor of the convertibles issued through issued through this preferential route. So if you look at it presently, it's only for the 18 months, and the kind of situation where presently in, and the business are facing the unpredictability, and how long it's going to continue. From that perspective, if tenor can be increased, then definitely that will become very helpful, not only for the corporates but also from the investor perspective. So that's more on
Um,
a preferential issue perspective. And also, if you consider QIPs, then we have just seen SEBI has reduced the gap between the two QIPs. So it's more from the faster access to the capital. But from a fundraising perspective, from the QIP itself, if you look at it, then I think the most important amendment or relaxation what we are looking at is on the pricing front. So presently, QIPs are sold with 5% discount to the 2 weeks average. So either that discount can be increased to 10% from its existing 5%, or this look back period of 2 days can be made to the closing day prices, and discount of 5% available to on that. So that can make it a very attractive proposition from the fundraising perspective. And obviously, you can reduce the lock-in period for the player.
Yeah. I guess SEBI's done a lot on the rights issue front already, and there is already clamor, among some participants that some of these changes should have a more permanent character, and they should be here to stay, rather than a limit of say December 31st or maybe 1 year or 2 years. Also, I think SEBI needs to resolve this whole issue about acquirer not, under the takeover code, there is a relaxation. One of the conditions to qualify for that relaxation is that the acquirer should not have renounced its entitlement. Now, that becomes particularly tricky when the renunciation is happening inter se between the promoter and the promoter group. As such, there is no distinction between promoter and promoter group entities. So, as long as the overall bucket remains the same and there is renunciation within that bucket, SEBI should allow. It's not a new demand because this has been on the wish list for quite some time, but perhaps now is the right time to go ahead and make this change. So that's one. The other thing is, maybe it's also the right time for FPOs and rights issues. It might make more sense for SEBI to move to a more detailed disclosure regime for continuous disclosures, similar to what you have in the US with your 10Ks, 8Ks, and 20Fs. That would ensure a faster access to market for a lot of issuers, and would also make some of the information asymmetry in the Indian market go away, and it will really be a long-lasting change that SEBI can bring in. Prashant, what about IPOs? Because uh, although not right now, but in 6 months' time, IPOs would again, become the talk or the focal point. And at that time, what can SEBI do to facilitate IPO activity?
Yeah, I agree. It's a lot of discussion is happening whether IPO market is completely will it wash out or whether it's going to come back. But presently, from this context of present situation and how to address it, that perspective, some of the points that are coming to my mind in terms of wish list for the IPOs, that the minimum subscription levels should be temporarily relaxed to 75% in line with the relaxation given to the rights issue for the IPO market also. Also, a lot of fundraising, we are looking at it that it's a mandatory kind of a fundraising corporates has to do to comply with the minimum MPS requirements. So from that perspective, in present scenario, if you can give a temporary relaxation for them to go ahead with the minimum shareholding requirements of 10% for the 2 years, and then gradually increase the public float to 25% over the following 3 years. So that can be very helpful. And another challenge that can be addressed is about how to simplify the variation in objects in such scenario when there is a lot of unpredictability going forward. So essentially, I'm talking of amendment to Section 27 of the Companies Act, which talks about the variation in objects, which has been disclosed in the prospectus. So I think some kind of a temporary change or simple shareholders resolution for the change in object should be provided. That will make the things and life easier for the issuers. One interesting demand that can also be made is that allow the companies to file the DRHPs on a confidential basis, similar to the QIPs at this point of time, as many companies currently don't want disclosures about their businesses to be public for various reasons. And specific period of time may be then allowed for the public comments once we have the SEBI's in principle approval in place. So might we can think on that line and come up with that kind of approach.
Yeah, just a couple of points, and again taking cue from where Prashant finished on the confidential filing. Look, that's the norm in most parts of the world, not only in the US. That's the norm in most parts of Southeast Asia. So Indonesia, for example, the first filing you make is confidential. That allows the companies to test the waters, see if there's demand for that particular IPO in the first place, as opposed to having a situation where you file and then you have to withdraw or not go ahead. It sort of has a stigma attached to it, right, in public markets. So that might be a great way of getting people to come back to the primary markets on the IPO route, as Prashant said. The couple of other things that we are seeing with the delay in transactions happening, so deals which are filed, DRHP, let's say 6-8 months ago, and couldn't go ahead because of COVID. The question is, if they were to try and test the waters now, would you allow banks to print research again? Or would you allow the banks to go ahead and test the market using updated information? Because really, honestly, and I think Anjan pointed up on this earlier, no one's really interested in knowing what your business did in September 2019 or December 2019, because this is a very different world that we're living in 6 months down the line. And it's not just because of passage of time. So how do you sort of allow people to disseminate that information and test the waters of the back of new numbers? I think that's another relaxation that we might be looking at, either allowing people to file an addendum and making information public, and then doing some sort of testing the waters of the back of post-COVID information, if I may. The other thing, which is again common in other parts of the world, including in the US, is statements of financial information. I know SEBI is fairly strict about not allowing non-restatement accounts in the book, so you can't go with limited review numbers. And audit and restatement might not always be possible given the timeline. And so that has sort of killed a few IPOs in the past, and this is as good a time as any for SEBI to reconsider that. And allowing financial statements to be used for a longer period of time, as opposed to 6 months, we can allow them for 9 months. That would really help in this current situation. So yeah, I think those are the sort of points I wanted to make. Rohit, over to you.
Exactly. I think that wish list is what everyone's hoping for. Well, I mean, Denzel, I think we touched upon certain numbers that we have already provided for. But I'm assuming that there is also a lot of clamor for more. What do you see in the debt market? I mean, in the NCD space, domestic, where do you think changes can be made?
Yeah, thanks, Rohit. And I think we've had our own share of views on moratorium for NCDs. But I still think there is a lot of clamor for that one, definitely. I think another thing that SEBI could actively consider is having the concept of an anchor investor for EBPs. An anchor investor plays the role of acting as an anchor for very, very large issuers. And today, with the EBP platform, sometimes the guy who actually goes and works on the trade may not necessarily end up getting the bond. So an anchor investor, maybe with say 50% of the base issue, would help both the objectives, would also help the guy who worked on the trade to get his pound of flesh, so to say, and would also help the other market participants to have a level playing field in terms of getting the bond issue if they like it. That is one. I think SEBI could also look at MLDs as an approved security for mutual funds. We've already discussed about the public issuances falling off dramatically. They could look at some relaxations there to maybe fast track NCD issuances of pedigree corporates who have a very clean track record, so that the process gets far more liberalized and easy, and corporates can access another funding opportunity through the public issue rather than only depend on private placements. There has also been some discussion with regard to creating a charge on certain identified assets of NBFCs instead of a floating charge. I think given the nuances there in terms of multiple issuances, multiple trust deeds, SEBI may want to consider a case where the NBFCs can report through the trustees for the securities on a periodic basis. Having said that, I think some amount of clarity in the covered bond space could also well be forthcoming. Covered bonds are extremely popular world over. They provide dual protection to investors, both in the form of the balance sheet of the issuer as well as by having the assets ring fenced and pooled. So we've seen one small issue in 2019, but we haven't seen much after that. Maybe they may want to first, get in the regulations from investors' perspective as well, so that when this space really opens up, you have, the investors also ready to go and invest. Yes, Rohit.
So, Ankit, now we are drawing to a close of the available time with us. So I'll try and summarize how the next few months looks like, and what according to you will be the outlook for the equity markets in terms of deal activity in the short to medium term and medium to long term. How does it look?
In a nutshell, not good. We probably see rights offerings continue, where people trying to consolidate their shareholding at this current pricing. Then perhaps QIPs come back first in the next sort of 3 to 6 month period. And with Prashant Kohli's blessing, IPOs coming back 6 to 12 month horizon. So I think that's really the timeline we're looking at, with rights offering preceded by QIPs and then IPOs. But it'll be a long road, and it all depends really on how this pandemic plays out.
Prashant, how optimistic should the corporates be today at a time when all these changes are happening around them, and should issuers wait on the sidelines, or should they go ahead? What kind of sectors will see more activity and what will not? Because in the last few months we are seeing some trends emerge. It looks like the big are getting bigger and the small are not finding much space. What's your view on this?
It's clearly the raising capital in the future is may become tougher, and certain issuers are being opportunistic for raising their capital while they can. And if you look at it, a clear distinction is emerging among the Indian businesses. So with the large Indian conglomerates who have found easier access to capital, they are accessing the funds wherever they can. And another is non-investment grade mid to large caps, which are generally finding it tough to access the capital, but now finding some purchases post they offer the discounts. And apart from that, there are small and mid cap Indian issuers who are basically not finding any liquidity and struggling to stay afloat. So worst, coming back to your question on the sectors, the worst affected sectors can be hospitality, airlines, ports, logistics, retail, and the sector where we can see they can actually perform well, I guess, can be pharma, healthcare, diagnostics, telecom, even e-commerce, FMCG.
Thanks, Prashant. Anjan, any closing remarks on what can be done to remedy and improve the situation?
Sure. From a foreign capital perspective, I think 2 or 3 critical things that is important is allowing end-use regulations to relax a little bit, because the need of the hour is working capital, the need of the hour is general corporate purpose, and therefore relaxing that tenor for raising ECB could be one of the positive moves. Secondly, could also be on relaxing the pricing caps. Pricing caps were quite relevant earlier, but having currently, when all the central governments have been reducing the base rates to almost like near zero levels, and we have seen the LIBOR come down to less than 0.75%, it really questions that how do we look at the pricing cap in the current context. The one other aspect could be there could be some other relaxation on the refinancing and restructuring of foreign loans, because that will also help a lot of the companies who have existing loans to either go for a longer tenor and refinance their position, which is due in the next 1.5 years, or even restructure in case of certain distressed companies. In terms of convertible bonds, I think Prashant did highlight one of the points with respect to the tenor. I would just add that to the extent it's possible, we should also evaluate whether convertible bonds could be considered for private companies also, because then that adds another revenue for corporate issuers to raise capital from the overseas market.
Tenzil, what about you? I mean, do you see any changes that can be done, maybe from a regulatory side to improve demand, access of liquidity to the industry? What do you think could really be brought about now?
So, Rohit, if India has to become a 5 trillion economy, as envisaged by the Honorable Prime Minister, I think a prerequisite or a precursor has to be a very robust and vibrant corporate bond market. While a lot of effort has been put in by the regulators addressing the supply side, by nudging corporates to incrementally borrow 25% of their incremental borrowing from capital markets, stronger disclosures, the EBP platform, which ensures transparency and a level playing field, more accountability from rating agencies, auditors, the trustees. I think when it comes to the demand side, we clearly see that has not kept pace. And you cannot have an equilibrium if one side is very lopsided. So I think encouraging QIB, that is the qualified institutional buyers, to actually base their investments more on fundamental research and analysis rather than having rating thresholds could be one of the options. So giving the freedom to qualified investors to actually pick and choose the credit that they want to invest, and being agnostic to what the rating could be. You could have an A+ rated corporate who is low leveraged versus a AA- corporate who is highly leveraged, and that could definitely be one. They could also revisit the restrictions with regards to unlisted investments from mutual funds in securities. There have been multiple points on what is the criteria that mutual funds can do if they have to buy unlisted. So that could be done. They could revisit banks' investments in zero coupon bonds. Another case I think could be that post the credit default, we've seen a lot of long-term investors shy away from private credit. And early resolution of the default cases could just be something that is due, or I should say long overdue, so that some of these investors could at least come back and invest back again in the private credit space. In terms of trends, and as a parting shot, I would see that for lower rated issuers or corporates, we clearly see that they will be coming back to the banking channel for raising capital, either to loan or bonds, because at least the immediate scenario is such that the banks seem to be far more competitive in terms of pricing, given the challenges that NBFCs and other large investors have been facing in the recent months. However, I'll hold my comment at that, and leave it to see how the situation unfolds in the next 3 to 6 months.
I hope RBI and SEBI are somewhere listening. Thanks a lot for that, Enver.
Yeah, some very, very insightful comments and suggestions from our distinguished panel. Thank you, Prashant, Anjan, Denzel. I think very insightful, thoughts on where the market is today and how it's going to look in the next few months. What are the steps that can be taken? Ankit, thanks to you as well, for bringing in your perspective and for also co-hosting this session with us. So, Deepak, over to you.
Yeah, thank you so much. Thank you so much, all eminent panelists. The session was truly insightful. As Jitesh said, it has clearly laid out the path which needs to be undertaken for the development of the capital markets in India, the way you have highlighted the issues and the recommendations. And if taken up appropriately with appropriate regulators and the Ministry of Finance, we can surely see our capital market being catapulted to greater heights and thus assisting our economy as well. So great. And participants, thank you so much for joining and helping us in making this session a success. And look forward to again working with all the panelists, and stay safe. Thank you.
Thank you.
Thank you, Deep. Yeah.
Thanks.